Welcome to The Explainer. Today, we're diving into something pretty huge, a claim from our source material that a major economic reset is coming in 2026, and it could completely change how you think about your money. So let's just kick things off with a question that's, well, it's a little unsettling. It sounds like something out of a thriller, but this idea is at the very core of what we're talking about today. Okay, so here's where it gets specific. The source we're looking at isn't just talking about some vague future event. They're pointing to a date, May 15th, 2026. Now, why that day? It's not random. That's when the current Fed chair's term is up, which could swing the door wide open for a new leader with a totally different game plan. So, what exactly is this reset we're talking about? It all boils down to a potential change-up at the very top of the Federal Reserve. A new person in charge could mean a complete 180 on economic policy. But wait, why would we even need a reset in the first place? Well, to get that, you have to understand the size of the hole we're in. And believe me, it is a massive hole. $39 trillion. Just let that number sink in for a second. That's the U.S. national debt, according to our source. It's a figure so big, it's hard to even wrap your head around. But its consequences are very, very real. And this is where that giant number really starts to hurt. The fastest growing part of the government's budget isn't for roads or defense. Nope. It's just the interest payment on its credit card. Over $1 trillion a year just to cover the interest. This chart really puts it all into perspective. It shows how much we owe compared to what our entire economy produces in a year. And look at that projection for 2026, 125%. That's higher than it was right after we paid for World War II. Well, it's a big deal. So, you've got this mountain of debt. How on earth do you deal with it? Well, the source says we should look back in time for the game plan. And here's the kicker. The plan isn't really to, pay it back.
The name for the strategy is financial repression. It sounds complicated, but the idea is actually pretty simple. It's when the government intentionally keeps interest rates lower than inflation. So if your savings account is paying you 2%, but the cost of everything is going up by 4%, you're not making money. You're actually losing buying power every single year.
And this slide just lays it out perfectly. There are clear winners and losers here. The government, who's the biggest borrower of all, wins big time. They get to pay back their debt with cheaper dollars. But who loses? Well, anyone trying to save money. Your cash in the bank is just melting away little by little. And listen, this isn't just some theory. It's worked before. After World War II, the U.S. did this exact thing. And by letting inflation and economic growth run hotter than their borrowing costs, that massive debt pile just shrank relative to the economy. They took it from a scary 106% all the way down to a totally manageable 25%. But you know what they say, history rhymes. It doesn't repeat. And there's a big, big difference this time around. Back in the 40s, the government locked in low rates for a long time. Today, a lot of our debt is short-term. The source uses a great analogy. It's like the whole country has an adjustable rate mortgage. So if rates go up, the pain hits fast. Okay, so given that big difference, how would you run this playbook today? Well, the source lays out a potential 3-point plan. It connects to Kevin Warsh, who might just be the next Fed chair. So here's the plan in 3 steps. Number 1, cut interest rates below inflation. That's textbook financial repression, right? Number 2, shrink the Fed's own portfolio of government bonds. And number 3, and this is the really 21st century part, bet big on AI to keep prices down. Okay, hold on. Did you catch that? Step 1 is cut rates, but step 2 is sell a ton of bonds. Normally, when you flood the market with something, its price goes down, which for bonds means interest rates go up. So what gives? How can both be true? Right, so how does the plan solve that puzzle? Well, according to the source, it's banking on a few big things. First, a belief that investors will just be lining up to buy all those bonds. Second, maybe some, let's call it, regulatory encouragement for banks to buy them. And third, this massive faith that AI is going to lower the cost of everything, creating a powerful counterforce to keep rates down. Okay, so that's the big picture stuff. But what does all this economic maneuvering actually mean for you, for your money? This is where it gets personal. And this quote from our source just nails it. Inflation makes the average saver poor, but it made the investors wealthier. That right there is the key takeaway for everyone watching. And here are those 2 paths, clear as day. If you're a saver with your money in a bank account, inflation is your enemy. It's a constant headwind, eating away at your purchasing power. But if you're an investor, if you own assets, things like stocks or real estate, those things have the potential to rise with inflation. They offer a way to protect and even grow your wealth.
Which leaves us with one last really critical question to think about. In a world where the government's strategy might be to purposely devalue its own currency, does playing it safe and holding cash actually become the riskiest move you can make?